Ever wondered about the difference between fixed funds and bond funds? Well, you're in the right place. Allow me to simplify this for you. Fixed funds, also known as money market funds, are a type of mutual fund that invests in short-term, high-quality, low-risk fixed income securities such as treasury bills and commercial paper. They are designed to preserve your capital while providing a steady stream of income. On the other hand, bond funds are mutual funds that primarily invest in bonds and other debt securities. These funds can include corporate bonds, government bonds, and municipal bonds. They aim to provide income through interest payments and, at times, capital appreciation. So, in a nutshell, both fixed and bond funds are instruments that aim to generate income for investors, but they do so in different ways and with different levels of risk. Now that we understand what fixed funds and bond funds are, let's delve deeper into their differences. Diving right in, one fundamental difference between the two lies in their investment strategies. Let's start with fixed funds. These financial vehicles aim to preserve your principal investment and provide steady returns. How do they do this? Well, fixed funds typically invest in a mix of short and long-term fixed income securities. This could include treasury bonds, corporate bonds, or other types of debt securities. The goal here is stability, a steady income stream, and most importantly, the preservation of your initial investment. Now let's contrast this with bond funds. Bond funds are a bit more adventurous, aiming for higher returns, but remember, with greater rewards come greater risks. Unlike fixed funds, bond funds invest primarily in bonds and other related securities. This could range from government bonds to high-yield corporate bonds. The variety of bonds in a bond fund's portfolio can lead to higher returns, but it also exposes investors to the risk of interest rate fluctuations, credit risk, and even potential default of the bonds in the portfolio. Think of it this way: fixed funds are like a well-prepared picnic. You know what you're getting: a sandwich, some fruit, maybe a cheeky piece of cake. It's safe, predictable, and satisfying. On the other hand, bond funds are more like a mystery box cooking challenge. You might get some incredible ingredients and make a gourmet meal, or you might end up with a combination that leaves a bad taste in your mouth. So, in essence, fixed funds are like a slow and steady tortoise, while bond funds are more like a risk-taking hare. But remember, in the financial race, both can reach the finish line. It all depends on your investment goals, risk tolerance, and time horizon. Whether you're the tortoise or the hare, understanding the difference between these two types of funds is an essential step in making informed investment decisions. Let's summarize the key differences between fixed funds and bond funds. Fixed funds and bond funds are two types of investment vehicles that can both play significant roles in your portfolio, but they come with different characteristics. Fixed funds, for starters, are known for their stability. These funds predominantly invest in fixed income securities, which provide a steady stream of income. They're like that reliable friend who always shows up on time for your lunch dates. They're great for those who prefer predictability and less risk. On the other hand, we have bond funds. These funds invest primarily in bonds and other debt securities. While they have the potential for higher returns, they also come with a higher level of risk. It's a bit like going on a thrilling roller coaster ride. It can be more exciting, but it's not for everyone. One of the key differences between the two is how they handle market volatility. Fixed funds are generally less sensitive to market fluctuations, providing a more stable return. Bond funds, however, can offer higher returns in a favorable market but also pose a higher risk in a volatile market. Just like in a balanced diet, it's important to have a variety of investment types in your portfolio. So, fixed funds and bond funds each have their unique benefits and risks. It's just a matter of what suits your financial goals and risk tolerance. Before we wrap up, here's a little financial humor for you. Why don't we ever tell secrets on the trading floor? Because the walls have shares and they might spill the beans. On a serious note though, investing isn't about secrets. It's about making informed decisions. So whether you're looking at fixed funds or bond funds, remember, the best investment you can make is the one that aligns with your financial goals. Thanks for tuning in.